Why the $1 trillion Saudi arms deal won't touch the deficit and might make it worse. America is buzzing about a purported $1 trillion arms and investment deal with Saudi Arabia, hailed by politicians as a boon for jobs, economic growth, and national security. The narrative is familiar. America first, manufacturing, stronger alliances, and a windfall that will supposedly trickle down to everyday citizens. But when you strip away the rhetoric and follow the money, a different picture emerges. This deal won't reduce the federal deficit by a meaningful dollar. In fact, it could exacerbate it, thanks to a tax system riddled with loopholes, corporate strategies designed to minimize taxes, and a wealth extraction machine that funnels profits upward while leaving the public balance sheet in tatters. To understand why, we need to trace the flow of funds, from Saudi coffers to U.S. corporations, through the tax code, into stock buybacks and dividends, and ultimately into the pockets of shareholders. Along the way, we'll see how workers end up footing the bill, how automation accelerates the problem, and why real fiscal relief remains a pipe dream under the current structure. The deal in context, more than just arms. First, let's clarify what this deal entails. While often framed as a massive arms sale, potentially including F-35 fighter jets and other military hardware, it's part of a broader Saudi commitment to invest nearly $1 trillion in U.S. infrastructure, technology, AI, nuclear energy, critical minerals, and defense sectors. This builds on earlier pledges, like the $600 billion announced in mid-2025, and stems from high-level talks between U.S. leaders and Saudi Crown Prince Mohammed bin Salman. On paper, it's a jackpot. Foreign capital pouring into American industries, creating jobs and boosting production. But history suggests caution. Past Saudi arms deals, such as the $110 billion package touted in 2017, delivered far less, only about $14 billion by 2022, due to delays, cancellations, and geopolitical shifts. Even if this one materializes, the funds will arrive gradually over decades, not as a lump sum, and crucially, none of it directly plugs the federal deficit, which clocked in at around $1.8 trillion for fiscal year 2024 alone. Step 1. A gutted corporate tax base. The story begins with the erosion of corporate taxes over the past 4 decades. In the 1980s, under Reagan, the statutory rate dropped from 46% to 34%. It hovered around 35% for years before Trump's 2017 Tax Cuts and Jobs Act slashed it to 21%. But these headline rates are deceptive. Thanks to lobbying, deductions, credits, offshore profit shifting, and other maneuvers, major corporations often pay effective rates between 0% and 6%. In 2023, all U.S. corporations combined paid roughly $420 to $500 billion in federal income taxes, a sliver of the multi-trillion-dollar federal budget. This shortfall didn't vanish. It was shifted onto workers and added to the national debt, now exceeding $35 trillion. A key culprit is full expensing of capital investments, accelerated under the 2017 law. Previously, costs for big assets like factories or equipment were depreciated over years. Now, companies can deduct 100% upfront for qualifying investments through 2025, with phase-out starting thereafter. For defense contractors or tech firms ramping up to handle Saudi orders, this is a godsend. Billions in revenue from the deal, offset by immediate write-offs for new production lines, robotics, facilities, and supply chains. Taxable profits? Virtually zero. Saudi Arabia pays no U.S. export taxes, banned by the Constitution's Article 1, Section 9. So the corporations rake in the cash, but the Treasury sees little to none of it. Step 2. Workers pay the price. With corporate taxes minimized, who funds the government? The workers hired to build these jets, AI systems, or infrastructure projects. They pay payroll taxes, 6.2% for Social Security, up to the 2025 wage cap of $176,100, and 1.45% for Medicare on all earnings, plus federal and state income taxes. These contributions are real and immediate, withheld from every paycheck, but they're no match for the deficit's scale. Social Security's trust fund faces a multi-trillion-dollar shortfall, projected to deplete by the early 2030s without reforms. Annual deficits run into the trillions, driven by military spending, $850 billion in 2024, interest on debt, $900 billion, healthcare, and entitlements. Even if the deal creates thousands of jobs, the added payroll taxes are a drop in the ocean compared to the gaps created by corporate tax avoidance and unchecked federal outlays. Worse, this burden falls disproportionately on middle-class workers, who lack the sophisticated tax strategies available to the wealthy. Step 3. Profits flow to shareholders via dividends and buybacks. Once revenues hit corporate coffers, net of minimal taxes, what happens next? Profits don't sit idle. They're distributed to shareholders, but in ways that further evade taxation. Start with dividends, the traditional method. A company pays cash directly to owners, taxed at qualified rates of 15 to 20%, plus a 3.8% net investment income tax for high earners. It's straightforward, and the IRS gets a cut. But dividends are increasingly out of favor because they're taxable and visible. Enter stock buybacks, the preferred tool of modern corporate finance. Instead of dividends, companies use excess cash to repurchase their own shares on the open market, retiring them or holding them in treasury. This achieves several feats. 1. Boosts earnings. Per share, EPS. Same total profits divided by fewer shares means higher EPS, which drives up stock prices. 2. Increases ownership stakes. Remaining shareholders own a larger slice of the company without buying more shares. 3. Creates tax-free wealth for non-sellers. Share values rise, but no tax is due until sold. For holders, it's pure unrealized gain. Buybacks have exploded, totaling over $1 trillion annually across U.S. firms in recent years. If the Saudi deal juices revenues for companies like Lockheed Martin or tech giants, expect a surge in buybacks. Shareholders win big, the Treasury gets zilch. For those who do sell into the buyback, they're supposed to pay capital gains taxes on the profit, the difference between purchase and sale price, at long-term rates up to 20%, plus the 3.8% surcharge. In theory, this generates some revenue, but in practice, wealthy investors, hedge funds, executives, and ultra-high net worth individuals use an arsenal of legal strategies to dodge or minimize this hit. These methods are employed daily on Wall Street, turning what could be a taxable event into a near-zero liability. Here's a breakdown of the most common techniques. 1. Selling through an offshore entity. If the stock is owned via a foreign structure like a Cayman Islands company, Bermuda Partnership, or Irish Holding Company, the sale occurs offshore. U.S. capital gains taxes don't apply, as the transaction is outside IRS jurisdiction. This is a staple for hedge funds and tech founders unloading large blocks of shares. 2. Selling inside a tax-deferred vehicle, holding stock in accounts like a Roth IRA, 401k, SEP, IRA, self-directed IRA, or charitable trust allows sales with zero current tax. Gains grow tax-free or deferred. Famously, Peter Thiel leveraged a Roth IRA to build a $5 billion fortune without owing taxes on sales. 3. Offsetting gains with harvested losses. Wealthy investors maintain portfolios of loss assets, underperforming investments. When selling stock for a gain, they simultaneously sell these at a loss to offset it, wiping out the taxable amount. This tax loss harvesting is automated and routine, ensuring net gains approach zero. 4. Donating the stock to a foundation before selling. Transferring shares to a family foundation, donor-advised fund, or charitable remainder trust lets the entity sell tax-free. The donor gets a deduction for the full market value, avoids capital gains, and often retains control over the foundation's assets. It's a powerful tool for billionaires to minimize taxes while appearing philanthropic. 5. Using QSBS, Qualified Small Business Stock. Under IRS Section 1202, early investors in qualifying startups can exclude up to $10 million, or more in some cases, in gains from taxes. Venture capitalists exploit this extensively for tech and startup exits. 6. Classifying as long-term capital gains with deductions. Even without full avoidance, long-term gains are taxed at preferential rates, 0%, 15%, or 20%, depending on income. Combined with other deductions, credits, and write-offs, for example, business expenses or charitable contributions, many reduce the effective rate to near zero. 7. Reinvesting through opportunity zones, 1031-like structures. By rolling gains into an opportunity zone fund, investors defer taxes, reduce them by up to 15% after holding periods, and eliminate taxes on future appreciation if held for 10+ years. It's a government-backed deferral mechanism popular among the rich. 8. Selling through a partnership or LLC. Ownership via an LLC or partnership allows complex maneuvers. Distributing losses to offset gains, shifting basis to minimize taxable amounts, allocating gains to partners with offsetting losses, or using accounting tricks to eliminate reportable income. This is advanced hedge fund territory, enabling customized tax minimization. These strategies ensure that even sellers into buybacks contribute minimally to the treasury, perpetuating the upward wealth transfer. Step 4. The buy, borrow, die endgame. The real magic happens for the wealthiest investors. Sitting on appreciated stock, inflated by buybacks, they avoid selling and taxes by borrowing against it. Banks offer low-interest loans collateralized by shares. Proceeds aren't income, so no taxes apply. Live lavishly on borrowed funds, deduct interest in some cases, and repeat. Upon death, heirs inherit with a step-up in basis, resetting the cost basis to current market value and erasing unrealized gains forever. A lifetime of wealth accumulation, fueled by deals like this, escapes taxation entirely. This isn't a glitch, it's the system, redesigned over decades to favor capital over labor. Step 5. Automation's double whammy. Factor in emerging technologies, and the picture darkens. AI-driven factories, Tesla's Optimus robots, and automated production lines are fully deductible as capital assets. They replace human workers, slashing payroll and income tax revenues while erasing corporate taxable income through upfront write-offs. The Saudi deal could accelerate this. Investments in AI and robotics mean fewer jobs long-term, even as short-term hiring spikes. Profits rise, shareholders prosper, but the tax base shrinks. It's economic efficiency at the cost of fiscal sustainability. Step 6. Why the deal could worsen the deficit. There's one theoretical way this could help. If Saudi funds allow cuts to the Department of Defense (DoD) budget, currently approximately $850 to $900 billion annually, by offsetting domestic needs. But that's fantasy. Expanding the military-industrial complex creates inertia. New facilities, jobs, and lobbying power demand sustained funding. When the deal winds down, contractors pivot to Congress for more contracts, ratcheting up spending. Result? Higher deficits, more debt, weaker dollar, rising inflation, all borne by workers through higher taxes or eroded purchasing power. Step 7. Toward real reform. If America were serious about deficits, we'd overhaul the system, enforce effective corporate rates above single digits, tax buybacks like dividends, close capital gains loopholes, restructure healthcare to curb costs, and scrutinize DoD spending. But these aren't on the agenda because the setup serves its architects, corporations, and shareholders flawlessly. In the end, this $1 trillion deal isn't a deficit cure. It's a shareholder jackpot disguised as patriotism. Saudi princes invest, CEOs celebrate, hedge funds borrow against gains. Meanwhile, the workers building it all watch their taxes rise, benefits shrink, and a $35+ trillion debt pile up for future generations. That's the truth of the system and who really pays for it.